One of the characteristics, you too, one of the characteristics investors are looking for in a trade is a return on dividends. Now we're going to discuss some dividend aristocrats with our next guest. I love this. Thomas Hayes is with us, chairman and managing member of Great Hill Capital. I think this topic is probably one of my dad's favorites, but I get what you're talking about. Let's start, though, with something very tangible right here, earnings season. It's just around the corner. We obviously are kicking it off on Monday. I saw JP Morgan on the list. What's your overall feeling on the performance that we could be getting? I see ConAgra, Pepsi, BlackRock, Citi, Delta, Bank of America. These are just Wells Fargo. This is just Monday and Tuesday.
Well, Nicole, thanks for having me. The good news is earnings are going to be better than ever. They're projected to be up 63% year on year. Easy comps, of course, with the whole world shut down. My guess is it'll strongly exceed that and will be up 70% year on year. That's the good news. The bad news is that all you're going to hear is peak growth every time you turn on the TV for the next 2 months. And certainly the rate of change is going to slow down, but I do believe we're going to continue to grow above trend for the next 2, 3, 4 years. We're still early in the business cycle. But as it relates to dividend aristocrats, which you alluded to, Nicole, I think with the 10-year yield now comfortably below 150 basis points, the demand for that type of regular income has certainly increased. And when we talk about the dividend aristocrats, we're referring to there are 65 companies within the S&P 500 that have not only paid dividends every single year for 25 years or more, but they've raised their dividend every single year for 25 years or more. And a great example of that is Warren Buffett bought about 400 million shares of Coca-Cola from 1988 to 1994. Now, his basis on the stock was about $3.25 a share. And when he bought it, the dividend yield was probably in the low single digits. Today, it's about 3.1%. However, because they raised the dividend every year over the last 27 years, his current yield on cost is 51.6% per year dividend yield. And that goes up every single year. So, he's received on his $3.25 basis in Coca-Cola, dividend aristocrat, he's received $21.45 in dividends alone. Yeah. That's 6.5 times his initial investment. And the stock's at 54, so it's up 16 times. So over 27 years, with dividends and appreciation, he's up 23 times. And there are still many good quality dividend aristocrats available today.
I love it. I love it because people do count on the dividend, and these aristocrats are known not to, forget about cut it or, reduce it or take it away. But in this case, increasing the dividend, like you said, for 25 years in a row, right? If you miss a year, then you're not an aristocrat anymore. So I think you make a great point. Tell me about some of the opportunities quickly. Defensive stocks, you have staples, utilities, healthcare. Where do you see folks making money in the next year or 2 or 3?
Yeah, I think certainly seasonality over the last 20 plus years on average favors defensive over the summer. When you get into sell in May till October, you get a little more volatility. You want to have some defensive exposure. So to your point, staples, utilities, healthcare. In the staples group, you've got a group here that are yielding about 2.5% currently, but remember that's going to go up every single year. You've got the Cloroxes, Colgates, Procter & Gamble, Kimberly-Clark. Now, these all took a hit recently because their earnings had tough comps from last year. Everyone's stocking up in the pandemic. They're going to work through that, and their input costs went up, but now they're going to pass that on to the customer. So they're going to get their margins back. You're going to get the dividend. You're going to get some capital appreciation recovery in the back half. So we like staples. We like utilities. And by the way, all of those companies in the staples, they've increased their dividend every single year for a minimum of 45 years. And in the case of Procter & Gamble, 65 years. So it's pretty exciting to see that. Utilities is another group. Con Ed and NextEra Energy. Con Ed just got a rate approval increase. So their income's going to go up. They're yielding 4.28%. And NextEra Energy has a lot of renewable exposure. They've been increasing their dividend for 25 years. And then finally is healthcare, which we like. J&J, they've increased their dividend for 59 years, and Walgreens Boots Alliance, they just announced same-day delivery everywhere in the U.S. They've increased their dividend for 45 years. And by the way, they're trading at just 9.5 times next year's earnings. So there's some good value in this group in the short term. They've taken a breather so you can get some capital appreciation. But in the long term,
Right.
we're looking for those dividend raises for the next decades to come.
Tom, great to chat with you. Thomas Hayes, thank you, Chairman and Managing Member of Great Hill Capital. Good stuff. Thank you very much. Thomas Hayes there. Thank you, friends, for joining me here on Market